Welcome out to another edition of the Trading Justice Podcast, number 591, as we have an extension from last week's conversation on chaos and opportunity. For a technician, this week made a lot of sense. There were a lot of technical consistency, even in the wildness. And if you want to become a master trader, a master technician, encourage you to sign up for a free trial, become a pro member, attend our upcoming Master Trader event where Matt walks you through the basic foundational principles of becoming a great trader. Matt, you do a great job with that class. I know our pro members, I know new traders appreciate it. How are you doing as we start this podcast?
Doing good. Excited to be here for another edition of the pod. And we are teaching our August Master Trader Workshop on August 19th and 20th at 6 p.m. Eastern Standard Time. We cover technical analysis in that course, obviously, as you stated, but we also teach trading options and using options as a vehicle of your choice when it comes to navigating the financial world and going out there and popping some good old-fashioned swing trades. Day one's all about technical analysis. Day two, we get into trading options, and it's real simple to be able to attend that workshop. It is a amazing class. You're going to learn a tremendous amount. We teach this course once a month at Tackle Trading, and the August edition is on the once again, it is right there on the 19th and 20th, and all you have to do is be a pro member to attend the class. It's a 2-day class. Each day is right around 2.5 hours, and it is a great class, chock full of amazing content, and you'll whether you're a beginner or experienced, I promise you're going to get a tremendous amount of value out of it. So come be a pro member and sign up for the Master Trader course on the 19th and 20th. It's free for pro members.
Yeah, absolutely. Matt, last week we titled the podcast Chaos and Opportunity. And you didn't have to wait long for the chaos to really unfold. You know, this is one of those traders around the world. They usually know other traders that are in community. They have a friend. I have a feeling like you and I on Sunday night called each other a few times. I'm pretty sure traders around the world called each other because it started fast and furious on Sunday in what was a very exciting futures open, to say the least. The futures open in the United States coincides with the opening in the Japanese markets. Matt, talk a little bit about that chaos, what caused it on Sunday night, which, you know, with the Japanese open. It's a fascinating story. It's one for the history books.
Well, we record the podcast on Saturday. We released the podcast on Sunday. And last week when we were talking about the market environment, we were talking about the chaos, the opportunities that occur within a little bit of volatility within the marketplace. And we knew the Japanese had already raised rates. We talked about it in last week's podcast regarding the ultimate concern that may play out as the Japanese yen carry trade starts to get unwound into the market. We didn't know how rapidly aggressive we would see the unwinding of that, given the fact that we were really only dealing with a 0.25% interest rate increase in the Japanese yen. But for those of you that are unfamiliar with why that is important, we're talking about the number one trade in the world getting unwound. And when the number one trade in the world gets unwound, meaning everybody's got to dump and recalibrate a little bit, well, that creates a tremendous amount of volatility in the market. And specifically when you're talking about the carry trade itself, the carry trade as in relationships to the Japanese yen. The Japanese yen is the number one currency used in the carry trade throughout the world. The carry trade is a very simple trade to understand. In fact, every single person listening to this podcast this week, you participate in the carry trade. Every single person in humanity does. You have a savings account, you have a checking account, and you go and you get money, oftentimes from a paycheck, and you go park that money in a checking and a savings account, and that currency is an investment that the bank will pay an interest rate for you to park that money in a bank or a savings account. Now, obviously, with the central bank being at 5%, you're going to be a little bit, you're going to get paid, or you're going to carry a little bit of a positive interest rate. And so each currency has an interest rate associated to the currency. Each investor in that currency gets paid a portion of that interest rate that is associated to the currency that is set by their central bank. In Japan, the central bank sets interest rates for the last, 20 years at zero, effectively negative. It was at negative 0.1%. With quantitative easing and all the Japanese, modern monetary effectively was even more negative than that. Well, what occurred between 2010 and really 2022, I want to say, that 12-year stretch, the carry trade was non-existent. And the reason it was non-existent is because you couldn't find something to carry. The US dollar had zero interest rates. Well, guess what? So did the Japanese. So did the Europeans. So did the British. So did the Canadians. So did everybody. And so to participate in the carry trade during that time frame, you would have had to buy and just to define the carry trade very quickly. So everybody understands you put money in a savings account, you get paid a little bit of money. We all understand how that works. The carry trade is when you do it simultaneously on a Forex transaction, where you buy one currency and you simultaneously sell another currency. And so when you buy a currency, you get paid the interest. When you sell the currency, you have to pay the interest. The difference in those two interest rates is what you effectively carry. And the reason it's named the carry trade is that's the only reason you're doing it. You're simply trying to capture the positive difference in the interest rates between two currencies. And between 2010 and 2022, that 12-year stretch, every major central bank around the world effectively had zero interest rates, which means there was no carry trade in terms of the major central bank currencies, which means you would have had to go take the risk of owning a Brazilian real or a Turkish lira or a South African rand or
so it wasn't so concentrated, right? Because you're the currency expert. I'm as much a listener on this as anything. So as a listener, I'm like, so it wasn't so concentrated in maybe a single trade or two trades. It was spread out.
Not even was it not concentrated, Mark. It was non-existent, because my point is you're not going to take the risk of owning the Turkish lira to get paid the difference in the interest rate. That's like picking up pennies in front of a freight train. That's really, really difficult, because what happens if in Turkey something economically bad happens? Well, all of a sudden, you're taking the risk of the owning of the Turkish lira against the US dollar, and I would rather own the US dollar than the Turkish lira, and they're not paying a high enough interest rate to offset that. That's the point on the exotic currencies out there.
But then central banks started raising interest rates.
Sets in post-pandemic.
Okay, I'm seeing it.
Inflation sets in post-pandemic, and the central bank starts raising rates. Europe starts raising rates. Everybody around the world starts simultaneously raising rates, except Japan, which never raises rates. And so over the last couple of years in the Forex market, you've had this massive concentration of institutions, hedge funds, banks, central banks, government agencies, you name it, participating in buying the dollar, buying the euro, buying the CAD, buying the British pound, buying these other major currencies with higher interest rates, and selling the Japanese yen. Because if you're going to buy the dollar and get paid a 5% interest rate, and you're going to sell the yen and you're going to have to pay a 0% interest rate, you're going to carry a positive 5%. Now, it doesn't work that way specifically, but you get the concept here. So over the last 2 years, Mark, as all these central banks have been raising rates and the Japanese yen have not, all of a sudden the Japanese yen last week start raising rates. And we talked about the concern of that last week. So we don't need to go into the detail of why that's concerning. Just realize it's very rare. And when it happens, it's concerning. And the reason it's really concerning this time is because the yen is the number one trade within the carry trade. And that had to get unwound. And we saw that volatility on Sunday during the futures open. We saw that coming into the cash open on Monday. But from that Monday cash open on, we had this became a technical event. because once it got unwound, it's
Yeah,
unwound.
this is a very important
It's different
to
than an
understand.
economic collapsing situation.
Like, this is important to understand from a, like, understanding what just happened is, yes, were there worries about slowing growth after the Fed that fed into some of the volatility that started? Sure, right?
That's still there. Slowing growth theme is still intact.
And we'll talk about that here in a few minutes. Were there worries of this? Were there worries of that? Sure, right? All of that. But once selling started, Matt, it was just a technical event, right? It just became that.
After the futures open, because a lot of this happens in the currency market, a lot of this happens in the futures market. And so once that cash open comes out on Monday morning, basically what we saw was, and you and I were sitting in the traders lounge, which is basically what we do every single day for our pro members. We're hanging out in the traders lounge. And from that point on, Chucky, from that moment on, the only thing we really talked about last week during the actual week, obviously a lot of this was on Monday's gap down. Throughout the rest of the week, the entire conversation was, we fully expect a bearish retracement.
Yeah, and I want to spend a few minutes on this. All right, so we hold a traders lounge for our pro members at Tackle Trading. We hold it every morning. Or in the first hour, if you're on the East Coast, 1 p.m. It's morning for us. It's morning for us. And so, when we hold that on Monday, there's a lot of chaos in the marketplace, right? Matt and I were very clear on the Traders Lounge. Our base case at this point was a counter rally, a relief rally. I don't know quite what we called it. I'll talk, but market goes up for here this week.
we called it a bearish retracement.
I'll share why I thought that was mine. Why did you have that as your base case on Monday morning?
Number one, I saw the unwinding of the carry trade as not a singular moment in time, but a singular event. I didn't feel like it was going to see additional follow through after the gap open. And the reason I say that is you just came into a lot of support levels. And when we talked obviously reversal analysis on Tuesday's coaches show as well, but when you are thinking reversal, and no, you're not thinking the immediacy of reversal analysis when you're dealing with the Japanese yen unwinding and a gap down scenario on Monday. But when you are looking at it through that lens, you see it through the lens of catalyst first. Where are those important catalysts in the market? And quite frankly, Mark, when you're looking at the NASDAQ on Monday gap down into kind of right around that 200-day moving average. Russell 2000 on Monday gap down into that 200-day moving average. Dow Jones on Monday gap down into the 200-day moving average. And yeah, the S&P 500 on the spiders didn't, but on the ES, it did. And so you just had a lot of support levels, and those support levels are extremely strong support levels. And that's just on the daily chart, Mark. I know there's other monthly moving averages that are acting as a catalyst right now as well. So the gap down situation created a technical moment where you were sitting at a catalyst. You were seeing slowing momentum already on the intraday going into the cash open on Monday. So we were already seeing the selling kind of subside on Monday morning, and you were at a catalyst, overextended to the downside. To any technician, and I'm just saying any pure technician, they're going to call for a bearish retracement in that environment.
Yeah, you're going to call it. Yeah. And for me, there were other factors on those, like whenever you have a volatility spike, when you go back and study historical volatility spikes, right? We got an ump on Friday, and then we got a double ump on Monday. That almost always marks the end of it. And you were coming into structural moving averages. And I want to point a couple of these out. First of all, go to the NASDAQ weekly chart. Whenever volatility strikes, I turn to moving averages to see. Now, moving averages cannot stop. If the dam wants to break, the dam's going to break and it's going to flood the town. But most of the
Volatility
time,
can break any support level. I don't care what it is.
it just doesn't matter what it is. I mean, COVID is going to always be a classic example of when true fear, not technical fear,
Yes.
when true fear hits, it slices through everything.
It will always be the kryptonite of technical analysis is volatility. Kryptonite stops Superman, volatility stops technical analysis. Those two.
But what we saw on Monday morning, as this was unfolding, because we have a couple hours before the lounge to gather our thoughts, study price action, is we saw pretty clean test off moving averages. And when I see a day like Monday, Matt, and I see a clean test off a moving average, I'm like, there's no true fear. I've seen true fear. You've seen true fear. This is not true fear. You don't bounce cleanly if it's true fear. Now, that doesn't mean true fear can't manifest itself 2 weeks, 2 months, 6 months from now. But on a Monday, where the Japanese market is going through Black Monday, having losses, the size when Bitcoin is down 15%, when there's chaos in the street, in the midst of all of that chaos, Matt, you bounce cleanly off that, and off the S&P, you bounce cleanly off the 9 monthly. So there were signs, weren't there, on Monday morning?
There were signs on Monday morning, but those signs were very technically driven on Monday morning. When you're looking at the intraday chart, for example, you started seeing it slow down right before the cash open, and then basically against that 515 level, you really didn't breach it all week long, and it tried to multiple different times. And so I'm not saying that the entire situation is resolved and now we can just get back into being the buyers against a bullish uptrend. I think there's still work to be to put in here, but just from the context of the carry trade to the expectation of a bearish retracement, that was the base case throughout the navigation of this week. But I also want to say something there too, though, Chucky. I also don't think the price action from Monday's cash open till Friday's cash close was a lot of people doing a lot of things. I feel like we're working out volatility, we're working out algorithms.
Matt, did you get a chance to watch CNBC at all this week?
Yeah, I watched CNBC a little bit.
Yeah, I got the biggest kick this week when I saw, them trying to explain price action as human market participants. Investors are really optimistic. I'm like, what human beings are involved this week at all?
I hung out with a whole bunch of traders this week, all week long, and traders are piddling. Investors are locking down hatches. They weren't buying the dip last week. I can tell you that. Not for the most part. Institutions bought the dip. Hedge funds bought the dip. They were on Thursday. I think they were net $14 billion positive on inflows. Retail and most humans out there were actually negative inflows last week. So it was an institutional moment. And if it's an institutional moment, you can just basically say that's an algorithm moment because they all run algorithms.
Yeah, and one of the things, Matt, and this is one of the interesting things that occurred last week, is that it's like pure algorithm in these moments when everything trades the same. Matt, we talk about this because this became a talking point in the Traders Lounge for us the longer the week went on, and we touched upon it in the Tackle Trading newsletter this week too.
Yeah, we've been talking about the recalibration of the market for a little bit of time, but that's what volatility does. That's what fear does, quite frankly. Fear is a unique emotion in the financial world where the collective fear makes everybody simultaneously do the exact same thing, regardless of whether or not you're looking at a value stock or a high flying growth stock. If you're looking at a cyclical play or a defensive play, fear impacts everybody identically. And so whenever you see these uncertain moments play out in the market, it does have a tendency to recalibrate the market and get it running on the exact same gasoline. And I started seeing early signs of that as we over the last couple of weeks. In fact, in last week's newsletter, I basically said my base case was for market recalibration. However, I just didn't know the path it was going to take.
Matt, you've been on this point in this podcast for over a month now.
Yeah, it's been since the start of earnings season.
Like you've said, and this was a great call, and it's played out in maybe a different way. But because the story of the market in the first half really was you've had a few stocks participate, they account for all the gains. Separate. The uncorrelated nature of indexes in your average stock. Well, that's
if you're recalibrating rotation analysis, we're really, really good at it at Tackle. But then again, you and I are both top-down analysts, so that certainly does help that rotationary conversation. But yeah, Mark, it was really since the beginning of earnings season, because I don't know if you remember, but a few months ago when I wrote the initial divergence between RSP and SPY within the newsletter, I talked about how the last time it did this, it took up until that June, July earnings season for it to get back into recalibration. And so it was my philosophy that earnings season in general was going to recalibrate the market to run a little bit on the same gasoline, because the earnings season
it did
is a little bit more of that macro environment. The path recalibration takes, obviously volatility helps that conversation a little bit more than consistency and technical analysis does. So the volatility came out. And when you're looking at the markets right now, it really does not matter. And I think, honestly, this is the most important part of this conversation as we go into next week, because the markets right now are running on the exact same gasoline. They have the same fuel. They're running on the same algo program.
When Matt says markets, it's small cap, it's the Dow, it's NASDAQ. And the sectors within, right? We saw a day where utilities was outperforming. No, markets are running on the same gasoline.
Yeah, especially from an index perspective. You look at the SPY, we're dealing with a short-term bearish retracement now. You look at the candles here over the course, and I know if you're listening to the pod, you can't see it, but just I'll describe it. 4 green, 1 red here this week in the spiders. In the diamonds, what do we got this week? We got 4 green, 1 red every single day, every single time frame. 3 green, 2 red, but the 1 red was by a penny on IWM. Qs, same degree of technical patterns we're seeing across the board. And so the volatility has recalibrated the indexes. The indexes are running on the exact same gasoline over the last week, because once again, that's not people making the decisions. If people are making these decisions, you will not see the pinpoint accuracy of the indexes all doing the same thing, because what drives IWM is really different than what drives the Qs. What drives the Qs is a little bit different than what drives the diamonds. What drives the diamonds is a little bit different than the broad-based approach of the S&P 500 itself. But regardless of index, regardless of space, you are running on the same gasoline. So if all the markets are running on the same gasoline, why do I think this is the most important part of the conversation? Because I do not expect the markets to run on the same gasoline as we move further into the development of the technical formations that are going to be dominant in this environment. And so there is going to be leadership set that stands out here. Does the leadership stand out on the top side, on the downside? That's an open question we're going to have to navigate this week, and I believe the CPI report is going to be a major player in that. What areas of the market sectors start to stand out? I think we're going to have a much better understanding of that as we navigate this week. If for example, Mark, if by the end of this week, IWM and the diamonds are the 2 best performing indexes, those are telltale signs that you are starting to see relative outperformance in the cyclical areas of the market and the rotationary trade that was dominant before we went through the volatility over the last couple of weeks. If you see tech start to lead here, well, what does that tell us? That tells us that the market's mentality is looking on the growth side of the equation, and they're getting ready for round 2 or round 3 of the AI trade. And so I feel like there's going to be some really important technical patterns that develop over the course of the next week, maybe 2 weeks, that are going to give us a really good understanding of where not only what does the market indexes want to do, what areas of the market want to run, because the patterns that I'm seeing over the last year, Mark, the rotation isn't swing trading rotation like it was back in 22. It's quarter to quarter. We're ending the quarter through earnings season. There's going to be a 2-month stretch here where I think we're going to get some clean analysis. And so I think this week, going into next week, the technical patterns that develop here are going to be extremely telling regarding what areas of the market are going to lead, what areas of the market are going to lag.
Yeah, no, and we titled this podcast Chaos and Opportunity last week, sensing some chaos and that there be opportunity that comes up as markets recalibrate, and then you have separation. We labeled it part 2. And I need to emphasize that this is the main point of the podcast, right? Is that when you have these conditions and then markets start to stabilize, it doesn't mean everything stabilizes. I mean, when you see certain sectors or industry or stocks leading, the market is not trying to trick you. It is trying to tell you. We saw this off
Not
October.
in these moments. Not in these moments.
We saw these off, not in these moments. Sometimes it will trick you but in coming off October 2022, you had a very specific group of, and it was kind of weird. It was like the Dow and industrials, and like it was a weird group that came off the October 2022 lows. Off the lows last year, it was tech that led, and then you had broad participation.
Yeah, and that's the quarter to quarter patterns I'm talking about, Mark. From that quarter, it was November bottom all the way to about February. It was cyclical that led, and it was cyclical hard that led. And then throughout that first quarter earnings season, it was technology that started leading, and technology led for 3 consecutive months and did absolutely fantastic. That's the question I have as we're now seeing the markets recalibrated here from a technical perspective, is coming through these technical patterns. And quite frankly, are we going to see a V-shaped type recovery where we start talking about bear stop out analysis at 540 on the spiders? Do we see something more of a double dip bottom to 510 and we see a little bit more constructive reversal type situation? I don't know the path that the market's going to take here. I just know that we're at a catalyst. We're seeing deeper retracements, and I'm starting to see the hallmark signs of early bullish short-term reversal situations.
Yeah, okay, let's go to Forex Factory in the calendar, and let's talk about a couple paths that the market could take. Because right now you have, basically the market running on the same gasoline. I like how you phrased that. Move down, move up, it all moves the same. But we don't have a shortage of events, right? We got nothing on Monday, right? The market was very calm on Friday. Wouldn't it be surprising to see it calm on Monday? Maybe, who knows in these markets, but then you start having, maybe the least important of the 3-day stretch, the PPI. But then Wednesday and Thursday, Matt, we've had wide trading ranges. I think we can expect wide trading ranges.
Especially on the economic data releases this week.
Yes, and particularly on Wednesday and Thursday. I know in the newsletter when I was writing about the economic and I was thinking through this, it was like, all right, you got scenarios. You got the CPI on Wednesday. You got basically the health of the economy, right? And it's nicely segmented this week, right? Because inflation isn't irrelevant yet, because the Fed has said that unless that starts coming down, we're going to be stubborn. And then, of course, on Thursday, with people talking about slowing economic growth, you get labor, you get health of the consumer, you get data right on that. So, I mean, what are some paths you could take here on Wednesday and Thursday?
Well, to me, the most important conversation is the technical conversation, and obviously the technical conversation.
Well, yeah, and how that fuels into those paths,
will off this economic conversation. I think first and foremost, algorithms are going to be extremely sensitive to economic data. I think people are going to be sensitive to the economic data. People are on a little bit of edge right now, and when you're on edge right now on having a will we or will we not economic conversation. Usually the market will price in a little bit more aggressiveness on the algorithm response. So I do think you need to take that into account this week. I also think this is a pretty standard economic week, quite frankly, and it's a normal economic week. We got PPI report in front of the CPI report. We get the CPI report in front of the retail sales report, and then you get initial claims to kind of end the week. That Tuesday through Thursday stretch is really kind of the most important economic reports we're going to get this week. If I had to label the importance of the economic reports, I put CPI first, retail sales second, initial claims third, and then the PPI report the fourth.
Yeah, no, and so Matt, like, going back to the technicals, and then we'll switch gears, talk about some earnings here, because we did have earnings season. I mean, it's easy to forget that.
Shockingly, we had 80 S&P 500 companies report earnings last week.
I mean, they didn't get any ink. They got
no love. They got no love. In fact, I felt like I was on an island last week reporting on earnings in the lounge every day. I'd report on the most important earnings, and nobody else in the market was having that conversation because they just wanted to talk about the indexes.
Yeah. Okay. I'm going to give you my favorite scenario this week, how it plays out technically, perhaps, and then you can talk about different things that can occur. Like, for whatever reason, PPI and CPI data sends the market down to some intraday support level that it's tested. Maybe it's the Thursday, maybe it's Wednesday. I don't know, somewhere along that range. Like, I'd be very, very surprised when I hear people talk about, well, we need to go test the market lows. So that almost never happens, right? Like the low lows, right? Like, oh, we need to go clear back down there, right? Well, that's going to create a more difficult situation unless it sticks that pretty cleanly. But there's some, intraday support levels.
I don't think you want to go to low. I think 516 is
I think 516, and if you form a little higher than that, but let's say, because you can have all kinds of narratives, and with algorithms, who knows? Maybe CPI misses.
520 would be a great number to get caught up on.
Yeah, I mean, there's levels, but maybe CPI actually comes in, inflation gone, but then all of a sudden algos sell it because, well, if inflation gone, how bad the economy. I mean, who knows what algos are going to do on Wednesday with the CPI numbers, right? You could have big rally, you could have big sell off.
Yeah.
But however it occurs, if I am sitting at an intraday support level, 520, I mean, something that's formed, and you head into Thursday, right? You came down a little bit, and then you have economic data that doesn't scream the apocalypse is coming. That would be my favorite scenario heading into what next week will be a very light week into Jackson Hole that happens that weekend. And we're going to talk about Jackson Hole in next week's podcast. Am I asking too much here from a technical perspective?
I don't think you're asking too much. I mean, whenever you track retracement analysis, pullback analysis, however you want to describe it, whenever you track retracements, bullish or bearish, we track it through the depth of the retracement conversation. And there's basically levels in retracements that you're going to be a little bit more concerned about. The 9 EMA is certainly one of those. The 20 SMA, 50 SMA, those are obviously two as well. But when you're looking at the depth of the retracement, the first thing is if the S&P 500 or whatever you're looking at gets back up above the 9 EMA in a bearish retracement. Once you get back up above the 9 EMA, and you're in that zone, you are officially above the 9 EMA here, but you're in that zone. But once you get back up above it, you start looking at standard, retracement analysis. It's kind of lost the momentum feel to it to a certain extent. And when you look at that from that lens, Mark, you're looking at one of two things. Either one, you're looking for the market to work back up into resistance, that top shelf of resistance, where if it breaches that level, it's no longer a retracement. And I would put that level at 540 on the S&P 500 itself. And so if you're gonna see that type of situation where the market just drives into 540, what you would also be seeing in that scenario, Mark, is one of two things. Either one, you would be looking at a high base type situation where you get into what's known as bear stop out analysis. Or two, once you hit into 540, you look for a shallow retracement that gets stuck on the 9 EMA, and then that pounds the ceiling back up. That's that 1, 2, 3 V-shaped recovery reversal pattern. It's what I teach people at Tackle Trading all the time in terms of navigating reversals. Reversals happen on every time frame: intraday time frames, daily time frames, weekly time frames, monthly time frames. The craziest thing in the history of the financial world is for people to declare the end of humanity simply because we're seeing short-term volatility on the daily chart. Longer term reversals, the reversals that you need to get worried about for your 401k, your IRA, they happen on weekly charts. They oftentimes don't happen on the actual daily chart. And so when you're looking at this daily chart right now and you're navigating the S&P, the first pattern that can develop here is known as a bear stop out pattern based on a deeper bearish retracement coming into 540 and then either seeing a high base at that level, or two, a shallow flag at that level that will catch itself on the hooking 9 EMA, which is starting to hook already. And so that's the first pattern, Mark. And I do think that's kind of the number one trading pattern you would want to see if you're looking to be a little bit aggressive here against the price action. Those are the types of momentum patterns you really do want to see. Now, on the flip side, Mark, let's see, we do get something to the downside here this week where the market starts to come down a little bit. Well, certainly it can come down to all the way to 510, which is where the cash open Monday cash open dip got bought. But you got a lot of support around 520 intraday, and you do have a really, really important level around 516.
It would really surprise me if you went down that far.
Yeah, from an intraday perspective. So the second pattern, Chucky, would be this, retracement that actually gets confirmed, but doesn't show any additional further selling than just the initial punch. And then you're back up into what would be known as a W formation. And that would be a really good scenario if you're looking more on the position side of the equation, or if you're looking at maybe on the investor side of the equation. That would be a little bit more consistent pattern to kind of work.
That would be a dream. That would be a dream. Having some version of that heading into Jackson Hole
that's a really good scenario going into Jackson Hole.
Oh my goodness gracious, would that be fantastic? Would that be fantastic?
Now,
Matt,
my buddy Frank always says, you might not get it, but you can ask.
And you can ask, right?
That's what we're asking for. And again, the reason I like to draw these things is because it helps me visualize what I need to see.
Yes.
What do I need to see so that when the price action happens next week, I'm not freaking out over random stuff. We have an understanding of what we need to see to get a little bit more confident in the bull price movement.
Well, it's like Wednesday's a great example of this.
Hold on. And then you can make your point. Once again, Mark, everything that transpired last week, when you go to Twitter and social media and people are like, oh man, I should have bought the dip. I should have bought the dip. Nobody bought the dip last week. That was algorithm on algorithm. And don't get me wrong, we were making some trades, but nothing aggressive. Traders were not being aggressive last week. Traders will not get aggressive until they have patterns to base probability analysis off of. And that's what I'm talking about, is the patterns that we need to see to so that we can even determine if we have an edge. Right now, I don't think you could describe participants having an edge as we go into this week. But as we come out of this week, we certainly could.
Yeah, no, and listen, in times like this, let me just be blunt. If you are not spending time learning and becoming great at technical analysis, you do not understand modern markets. When I watched CNBC analysis this last week, they don't understand technical analysis, so they don't understand modern markets. And insert mainstream financial media anywhere, right? Like when Wednesday's day, big red day, I was like, it didn't change. You came down 400 day support. I mean, it didn't change anything from a technical perspective.
Most of those traders on those shows were doing the exact same thing that you and I and most people at Tackle Trading was doing. We were lowering our time frame, lowering our position. We did more day trades last week than swing trades.
Yeah, listen. So be part of a team that knows technical analysis. Guess what? I know one. Sign up for a pro member. Go attend that master trader. Matt, let's talk earnings.
Yeah.
Because once we get out of this technical moment and the opportunity where we start to see leadership, and Matt, if it's Staples, guess what? I'll add some staples. If it's industrials, I'll add some. I'm going to let the market tell me, and I'm not going to question, that.
My head is, do we see
I think it's going to be tech.
breakouts? Do we see defensive breakout? Do we see aggressive form reversals? I think cyclical needs.
Yes, I think it is going to be some combination of tech defensives, right?
Mm-hmm. It's a weird combo, but you got
particularly staples and utilities.
Yes.
That's where I think.
Utilities,
but I'm gonna
utilities had a really, really good earnings season.
They did, but Matt, when this technical moment unwinds, when the opportunity presents itself, once the ebbs and flows die down, one of the things that people are going to be reminded of, and you can see the financial news headlines being written right now. Oh yeah, earnings weren't so bad. Like market rallying on, good earnings, even though it was like, they'll go fine. But earnings season wasn't too bad, was it?
No, I mean, like most earnings seasons, there's some good, there's some bad, there's some, ugly, there's some great, there's obvious takeaways. And I'll do a little bit more of a complete earnings update, kind of my letter grade and my final performance next week. But in terms of just earnings season update, we got about 91% of companies that have reported earnings so far. The blended growth, there's good and bad about the blended growth. The good is this is the best blended growth EPS rate, which means total EPS growth. We're at 10.8% right now. That's the best blended growth we've had since 2021. That is a really good number. Now, we are expecting to contract going into the third quarter to about 5%, but that is the best number we have had from quarter to quarter, looking at year over to year action since 2021. That's a really good number, but it was supposed to be a really good number. That was the expectation coming into earnings season. As we were sitting at 8.9% coming into earnings season, we finished at 10.8%. So that's good, but it is certainly not great. And there is a little bit of a negativity towards the blended growth, given the fact that the magnitude of the EPS beats were not significant enough to match the average EPS beat out there, which means on average, we see about an 8.5% beat rate against EPS. This go around, we saw 4.5%. And so obviously the blended growth did not get up to where it could have gotten up to. And it really didn't even sniff that 13% number that I established for a really good earnings season. I said at the very beginning of earnings season, we had to get about that 13%. We sniffed it at about 11.5, finished at about 10.8. And we do got a few components this week. We got Walmart reporting, Home Depot reporting, Applied Materials is reporting. I think there's 8 total S&P 500 companies. And so not a big slate here. The 11% right where we're going to finish on blended growth, pretty good number, but there was some negative context because it did not beat as much as it typically does do. When you're looking at the sectors, Mark, and I wrote about this obviously in the newsletter this previous weekend, utilities was quietly, and it's been there all earnings season. It's been like the third or the fourth best sector from an earnings perspective. But Mark, last week and a half, there's been a few good stocks coming out on the utility side of the equation. They had a 20.4% growth rate year over year from second quarter 23 to second quarter 24. No sector has a better growth rate than utilities from last quarter, second quarter 23 till today. Infotech right behind it. Finance had a really good quarter, but there's some concern on the carry trade regarding the finance, and obviously cyclicals going through what's the Fed going to do? And that was the concern when the Fed last week did not clarify exactly what they were going to do. It left cyclical in a sell first, ask questions later type of scenario. Materials quietly was the worst performing sector from a blended growth perspective, as obvious, commodity prices are lower right now than they were a year ago, specifically in a few of those commodities. Now on the EPS side of the equation, Mark, EPS beat about average, 78% is the 5-year average. revenue was a mixed bag a little bit. Revenue came in really good at 5.2%. That's the revenue blended growth. That is a really, really good number, but only 59% of companies beat the estimate. Now, what does that suggest when blended growth at 5.2%, but only 59% of the companies are beating the revenue number? It means the companies are learning how to become a little bit more effective and a little bit more efficient, despite having a little bit of top line challenges from an overall growth perspective. And so, honestly, last week was a really interesting week in earnings because it was all secondary. Everything in earnings was secondary. And it was secondary to the obvious carry trade and the macro conversation. Mark, my biggest takeaway on my earnings, and I obviously write about this in the newsletter every single week during earnings season, is basically this, Mark. Earnings season has been better than reported and has been better than average. We didn't see horrific numbers coming out of this earnings season. We saw really good numbers coming out of this earnings season. There is a slowing growth theme in tech and AI. That is there, and that's been there since ASML reported their first earnings report 4 weeks ago. Does Taiwan Semiconductor updating their guidance and basically coming out with a 45% year-over-year revenue increase from July of last year to this year, does that modify that slowing growth argument a little bit? I'm not sure. In the same time frame that we've had a little bit of a slowing growth conversation on the earnings front, we're also had a slowing growth conversation on the economic front. And then you had the carry trade, the labor market last week, and the Fed fiasco from last week. And that was that created a lot of volatility where there was already a little bit of concern on the slowing growth. My anticipation is, well, not my anticipation, but my philosophy is earnings are being discounted for macro environment concerns. Once those macro environment concerns dissipate, as they often do, not all the time do we see a repeat of 2008 and 2020. And so as those dissipate, which I do expect them to do, I think we're going to get back into hey, those companies have pretty decent earnings. And so earnings season was not the causation of the gapping and the volatility in the marketplace. Earnings season is going to be seen as a positive as we remove ourselves from this volatility, in my estimation.
Yeah, my big case, even if we are going to talk about earnings growth worries again, I think they're going to dissipate in the short term as well. And, when I look at earnings season, Matt, I didn't see any, because I'm a narrative, I didn't see any real negative ones. I saw some people try to throw out, well, Meta's not spending as much on CapEx. And
no, that's the entire AI conversation. You just nailed it. You don't even have to say another company because it's all rinse and repeat. And whatever, Meta is spending billions.
Yeah, but I'm like, I was like in mind, it's like, well, this,
like, stop it.
This is not going to
say you stop it. I'm saying
no,
like,
no, that's my general point. Is like these aren't major narratives. You want to know major earning narratives, go back to .com.
Yeah.
And I've been on the lookout for those things for 18 months, Matt, and I haven't seen them, didn't see them this one. So earnings, I think you got to view it as a positive.
I do as well. And sometimes it's very difficult to associate the causation for price action. It can be extremely difficult.
Well, ask CNBC how difficult that was this week.
They really struggle with it. They
market's going up, cause
is Twitter or is
reasons
worse when it comes to the laying of causation versus price action. In an environment where you got labor, unwinding of the yen trade, when you got concern over the central bank, overshooting, and you got some slowing growth concerns on earnings and from an economic perspective, honestly, Mark, I don't think it's one of those. If I had to pick one, I would pick the Fed. If it's not for the Fed, we're probably not having the Japanese yen carry trade unwinding. We're probably not overreacting to the labor market last Thursday. Or a week ago Thursday. So there's a lot of variables in that equation. To me, it's all about the Fed, but there is a lot of variables in that equation. I do not believe those variables are justified from an earnings perspective.
Yeah, let's get over and finish out a podcast.
Can I just say one thing real quick on earnings? This week, Mark, I didn't listen to your no. You are very concerned about retail, about the consumer facing companies, correct?
Yeah, for a while I have been,
Okay.
yes.
Well, you get the big dog out there, Walmart this week.
I don't worry about Walmart. Like,
Walmart, couple Walmart with retail sales.
I don't count them as a consumer facing company, even though
not count Walmart,
even though they're the largest consumer facing company out there, because they have pricing power. They have this, they Walmart, they're the Death Star. Like,
I can't argue with that.
Plus Walmart picks up business in slowing economic growth times.
Do I think Walmart would struggle personally if the consumer struggles? No, I think Walmart
I don't.
is a buy in comparison to the other retail companies that would struggle. I am right there with you, Mark. When people talk about recessions, they may hate Walmart, but they find themselves shopping at a Walmart.
But it will feed into the consumer narrative.
Yes. My point is that we will see the data relative to how consumers are doing.
Yeah.
That not necessarily be concerned specifically about Walmart, but if you are concerned,
and Home Depot,
Home Depot with big tickets this week, Walmart with small tickets this week, and retail sales. Those three, I expect consumer discretionary staples to move on those three reports this week.
Yeah, absolutely. Let's finish up the podcast looking at commodities. I know that from a directional standpoint, most commodity areas are blah. I'm pretty low in exposure. I look at things like silver, man. I look at things like copper, and I'm getting antsy. I'm like, I want to get some stuff going here, right? You had a big enough sell-off, boomerang style cash flow trader like I am. It feels like I want to do something. But I did want to get your take on dollar, because commodities have been like, the dollar's been doing its own thing lately, and you made a comment that I wanted you to expand on in the podcast about the dollar and commodities and how there should be some more correlation. I don't know exactly what the word is, but the thought I'm referring to. Will you expand on it?
If you think I expect, at the very first of the podcast, we talked about the market and our expectation of the market. And one of our base cases in the market this week is we're going to start to see a little bit of separation on the indexes. And as we start to see separation on the indexes, that's going to help us see separation on the sectors, which is going to help us understand exactly where this market wants to go and what areas of this market, where do they want to go. I think you can say something extremely similar about the dollar versus commodities this week as well. When you're looking at the dollar is usually a divergent asset class against commodities. And when you're looking at the divergent nature of the dollar versus commodities, it's obviously number one is dollar to gold. Those things have like a 90% divergent rate. Dollar down, gold up, gold down, dollar up. The industrial metals like silver, copper, palladium, platinum, they don't have that type of relationship oftentimes with the dollar. Their divergent status isn't necessarily as it is with gold, it being the precious metal. They'll move far more on cyclical analysis, which oftentimes can help the dollar. But Mark, in an environment where you have dollar breaking support, forming a bearish retracement, copper breaking support, silver breaking support, forming a bearish retracement, something has to give here. Something has to give here. And is it going to give on? Is it going to be the dollar in let me just, kind of get my thoughts out here. Is it going to be the dollar going into a very, very, very well-known interest rate cutting cycle that, because the Fed is being stubborn and won't clarify exactly what's on their mind, has held up the dollar a little bit in that environment? Or is it going to, or is it going to be silver, copper that start to show bottoming formations here? Because I do not believe that silver, copper, and the dollar can trend together. They can form patterns together, but and they can even short-term trend together. But I don't know if they can long-term trend together. And so I do think you're going to see a little bit of separation here. Last week, I kind of felt copper was that conversation. Copper was at the 200-day moving average. It was already sitting there with a little bit of slowing momentum. It had a real good trigger above 4.2. Obviously, we saw that continue to violate this week on copper. And we saw a little bit of additional momentum on the copper side. Now, can copper form a good reversal here? Absolutely, it can. But it won't be a clean reversal. It's going to be a little bit more of the head and shoulders variety than what I would say is standard M formation. You got a left shoulder, you got a head. Now, all we're missing here is a deep retracement followed by a shallow pullback, and that is the head and shoulders formation. And that would be really, really, really good pattern. And I still think 4.2 is the number if you're thinking about it from a buyer's perspective. But because of the violation and the additional volatility this week in copper, that kind of put that off to the radar a little bit, just off the radar a little bit. Still can go through the development, still can be really, really good above 4.2. We've been looking at that 4.2 handle for 2 weeks now. Can still look pretty good, but silver's now in that scenario where, okay, silver's interesting to me here. I fully expect, and if you don't mind, let me kind of get my technical thoughts out here on silver, and I apologize for the listeners if you can't understand the description, but I'll try to describe it for you guys. What silver is going through here is I expect another leg to the downside, but I expect that leg to the downside to be a slowing momentum leg to the downside. Why I say that, Mark, is you're looking at a scenario here on silver as it starts to approach that 200-day moving average, where the legs down are starting to contract a little bit. And that's well known as you start coming into major support levels. And so as you can see on silver, it goes from 32 down to 29. That's a $3 movement. Then it goes from 29 down to 26.5. That's a $2.50 movement. Well, if we see that same thing occur and we see a little bit of another leg to the downside here on silver, Mark, that could put it right there into that 26 level, which would be a really good support level for it. And so I kind of think silver here is a little bit now better in the development than even copper is, although I still can see some both having a viable path. I expect one more short slowing momentum leg to the downside on silver, and I fully expect a 200-day moving average test, and I fully expect a $26 support test on silver. But I also think you got to be prepared for bear stop out and whatnot. I just think another leg down with slowing momentum, dialing in that 200-day moving average on silver could be really, really, really good.
Yeah, no, and gold, not a lot to talk about. We'll talk about gold next week in the Fed a little bit more. Just doing gold's things. Another day that ends in Y, start a gold position. Unless you are a first-time listener, you know the gold is probably our favorite long-term asset. Bitcoin got in a wild ride. What do you say today? Finish off with Bitcoin, oil, and then let's finish up a podcast today.
Oh, I don't have much to say on Bitcoin right now.
Oh no! The thing I had on Monday was when markets are crashing down 50%, because I got about 4% of my portfolio in Bitcoin related assets right now, and it's like the James Franco meme first time. Yeah. It's not
yeah.
But impressive bounce back in its speed, but all it really did was just come back into a range. Right.
I'll have interest at whatever the next clean technical pattern is in 19 months from now.
Yeah.
Just the next clean technical pattern I will have interest in. On gold, a little short-term neutrality against a longer-term uptrend would suggest a breakout is in play here. That's all I got here today, though. Chuck, you want to go ahead and send us out?
Listen, the opportunity, watching the technical signals as they emerge, what area of the market is going to emerge. There's always something, every time. Technical analysis gives you an edge in finding that opportunity. Come sign up. 15-day free trial, tackletrading.com. Come sit your butt in the seat at that Master Trader event a week from now. If you sign up for a pro, you'll get lots of information on it. It's August 19th and 20th. Technical analysis helps you understand modern markets. It is that simple. Come learn from the best. My brother Matt. freaking amazing at technicals. You know, I don't need to anymore get more than my.
I do all your technical reads.
You know, yeah. Like Matt's here. He's like, and I talk to him 40 million times a day. I'm like, you know, so like, you know, learn from him. He's the best in the biz. It is an important skill set. It was totally in play this week. It will be in play in the coming weeks. It will be in play in December. It will be in play in 2028. It's time. Learn, grow, succeed. Everyone, have a fantastic week.
Later, team.